What if you think Bitcoin's as good as the S&P? If Bitcoin goes up 10% a year, even if it stays volatile at 40 vol, every one of these instruments is investment grade or investment grade equivalent, by our BTC model. You think that Bitcoin's going up 20% a year, you can see the risk just drops away. And now you've got credit spreads, 0 basis points, 5, 8, 9, 14 basis points. Anybody in the world running fixed income that wants fixed income that has a positive view toward Bitcoin looking at this model will see that these are all really compelling instruments. Now, what happens if you're a maximalist? If you're a maximalist, you can see the BTC risk drops a basis points, the credit spreads go to nothing. The spread premiums blow out. Is the world got a lot of maximalists? Yeah.
Michael Saylor has done it again, only that this time, the stakes are much higher. The relentless rise of Bitcoin is now colliding head-on with the world of corporate finance. And at the center of this storm, MicroStrategy, a company that's thrown out the old rulebook and gone all in on Bitcoin. In the second quarter of 2025, the numbers were historic. But behind the paper gains lies a brewing storm of risk, skepticism, and one of the boldest financial experiments Wall Street has ever seen. MicroStrategy isn't just holding Bitcoin, it's building an entire financial empire on top of it. While most companies treat Bitcoin as a speculative asset, Saylor treats it as digital bedrock, a volatile, unpredictable digital currency that doesn't generate cash flow, yet now powers a multi-billion-dollar public company. To most traditional investors, that's a red flag. But to Saylor, it's the future. Now, the second quarter of 2025 marked a turning point. MicroStrategy raised a staggering $18.3 billion in capital in just the first 7 months of the year. That's 81% of all U.S. preferred equity raised in 2024, a figure that's almost hard to believe. 4 new credit products were launched: STRF, STRK, STRD, and STRC. The last one, STRC, became the largest IPO in America this year. The financials? Absolutely jaw-dropping. GAAP operating income hit $14 billion. Net income, $10 billion. EPS soared to $32.60, possibly the highest in the S&P 500. Now, this isn't just a result of smart management. It's the direct impact of Bitcoin's price surge and a new fair value accounting method. So the big question now is, could MicroStrategy's radical model become the blueprint for a new era of corporate treasury strategy, or will it trigger the next speculative bubble? Let's watch more clips from Michael Saylor's and hear what he has to say on this. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
The analysts are all starting to cover and track Bitcoin, and they have outlooks for Bitcoin. So if you're going to cover the 160 Bitcoin companies that have Bitcoin on their balance sheet, you're going to have to form an opinion about Bitcoin. And so you can see that the average end-of-the-year price forecast of an equity analyst covering MSTR is 168,000. And so keep that in mind, 168,000 by the end of the year. That's the consensus of the analyst community that tracks our stock right now. Technology investors are looking for the next great thing, and everybody, the consensus trade is AI. Everybody knows AI is the next thing, but now they're starting to realize that Bitcoin is also the next thing, and it's being lumped as a technology transformation and a digital disruption. This is really positive because this is going to draw lots of Magnificent Seven investors into our space. Financial regulators are embracing Bitcoin. You see a new positive Bitcoin announcement just about every other day now from all parts of the government. Just a few days ago, the SEC released a memo allowing in-kind creation and redemption of Bitcoin ETFs. This is a huge deal. This is going to accelerate the development of the industry. Now I'd like to talk about our financial products and our business. As you can see here on this slide, our company's strategy sits between the crypto economy and the traditional finance economy. So the primary asset and the foundation of the crypto economy is Bitcoin, which is worth $2.3 trillion. And when I think about the crypto economy, I think about every country on earth and every capitalist on earth 24/7, 365 acting rationally in whatever their economic interest is. That's being manifested on Saturday night, and that's creating extraordinary performance and extraordinary demand to the underlying collateral, which is BTC. However, most of the world is unable to access the crypto economy, and so what we're doing is refining, and we're harnessing the power of the Bitcoin asset, and we're able to actually refine it into low volatility, low leverage, less risky financial products, and then higher volatility, higher leverage financial products. So just like you might refine a barrel of crude oil into kerosene, which would be very, very pure, and asphalt, which is not so much, we're basically providing a function that, say, an ETF cannot provide. You can see IBIT, the most famous example here in this chart. It basically wraps Bitcoin and it serves up a security flavor of raw Bitcoin to the investment community. We, on the other hand, are offering stepped down elements, convertible bonds, convertible preferred stock, senior fixed stock, junior high yield preferred stock, and of course this treasury preferred stock in the form of stretch. We're offering those, and those, in essence, we're stripping and modifying the duration of the asset, and we're also stepping down the volatility of the asset, and we're actually extracting the yield from the asset, which is Bitcoin, and we're serving it to each of these fixed income investors. But the excess yield, excess volatility, excess performance that does not go in those fixed income instruments goes into the MSTR common stock. And then, of course, that feeds to the MSTR-based ETFs and the MSTR options. So all of these are different instruments. They're all targeted at a different type of investor. They're all some of them offer yield, some of them offer return. So let's delve into them a little bit closer. First, Strike, STRK. Strike is structured Bitcoin. So some people, they don't want high return Bitcoin. What they want is something with less downside, less risk, less volatility, more certainty. So how do I actually keep the growth but get some yield certainty, strip some of the risk? And the way to do it is with a convertible preferred stock. If we look at the spec sheet here, what you can see is that in essence, at $100, a share of Strike offers about $40 worth of equity. So it's like at that level, it's a 40 delta, 35 to 40 delta instrument. So you're getting partial upside on MSTR. You're getting a guaranteed 8% dividend, and you're getting a liquidation preference and seniority in the capital structure. So less volatility, less downside, articulated yield, that you can count on, but you can still keep some of the growth. What's the market universe for that product? Well, you have growth investors, right? The S&P 500, they've got 9% year-to-date performance, and they've got 1.3% yield. Well, Strike is 7.5% yield effectively, and it's 34% year-to-date performance. So maybe the S&P index buyer, maybe a NASDAQ 100 index buyer. Between the two of them, there's about $55 trillion in that bucket. Then you've got commercial real estate, people that want some yield, but they also want some growth over time. That's another very large bucket, $30 trillion. Then you have hedge funds that give you downside protection. They may or may not give you performance. Oftentimes they don't outperform the S&P, but they purport to be hedges, and people like the idea of some structured investment. And that's what hedge funds do. And then another target audience is just Bitcoin investors. Maybe someone that doesn't want 55 vol, 55% performance. What they want is they want some guaranteed yield, some downside protection, but they still want to keep some of the upside of Bitcoin. And then that also goes for spot ETFs of Bitcoin.
Here's where Saylor took things to another level. He introduced a new valuation metric called Bitcoin per share, BPS, a bold move that reimagines how investors think about equity. In 2025 alone, BPS jumped by 39,716 satoshis. Since 2020, that figure totals 198,543 satoshis per share. In Saylor's world, earnings matter less than how much Bitcoin your stock actually represents. But it's not just about accumulating Bitcoin anymore. It's about financial engineering. Saylor has built what he calls a Bitcoin refinery, a system that converts Bitcoin's volatility into structured credit products. STRK offers partial equity upside with a guaranteed yield. STRF acts as senior debt. STRD targets high-yield investors. And STRC, a monthly dividend instrument tied to short-term yield, functioning almost like a Bitcoin-powered savings account. This isn't just innovation, it's a direct challenge to traditional finance. These products are over-collateralized well beyond industry norms. STRF and STRC by 10x, STRK by 6x, and STRD by 3x. For comparison, conventional credit markets rarely exceed 2.5x. It's a clear signal that Saylor's aiming for institutional trust, not just retail hype. The ultimate goal? To create a Bitcoin-based yield curve, a full credit ecosystem that could draw in trillions in global capital still untouched by ETFs or legacy instruments. If this actually works, what happens to Bitcoin's price when it's no longer just a store of value, but the backbone of global credit markets? Let's watch more clips from Saylor's session to gain more insight.
So that takes us to MSTR. What is MSTR? It's amplified Bitcoin, right? If you want more Bitcoin, if you want 2x Bitcoin or 3x or 4x the return and 4x the volatility of Bitcoin, you need a Bitcoin-backed equity. And we're aiming this for Magnificent Seven investors that they believe in the digital transformation of capital, right? We aim to be the Amazon of capital markets, right? Completely disrupt the business model. And you can see it in our metrics, where we're running 101% annualized performance 5 years in a row, right? In 10 days, it'll be 5 years. So doubling every year for 5 years, it's hard to say that's a fluke. And here's another illustration of amplified Bitcoin. You can see, bonds are underperforming, real estate's a 6%er, gold is a 10%er, the S&P is the cost of capital, 14%. The Mag 7 doubles that, Bitcoin doubles that, we double Bitcoin, right? And you can see in the last year, it's the same exact thing, right? Even more so. So I want to explain how we amplify Bitcoin. Okay, so we start with 199,000 satoshis a share, and if we have no leverage, if we had no credit strategy, if we couldn't issue credit, then 10 years from now we've got 199,000 satoshis a share. That's like an ETF. That's a BTC factor of 1. But if we issue preferred that's equal to 10% of our Bitcoin assets, that's 10% leverage, it turns out that we have 267,000 satoshis a share at the end of the period because we're not diluting the common stock as rapidly as we're building the Bitcoin. And if we go to 20% leverage, you see you end up with 376,000 satoshis a share. And now let's go to 30% leverage. So you can see at 30% leverage, we would have 555,000 satoshis per share. The green bars you see, that is the work that the treasury operation is doing. When people wonder what's the value added of a Bitcoin treasury company, it's the ability to create the green bar over the orange bar. And that's a 2.8 BTC factor. That means that, what does it mean? It means in essence, you would think that the floor for MNAV for a company that's got this sort of performance is 2.8, right? It's not the MNAV, but it's at least the floor. The MNAV of the company should be higher than 2.8. Now let's delve a little bit deeper into this idea. So I'm going to show you what happens as you increase the leverage in a Bitcoin treasury company like ours. You can see if we have 30% leverage and a Bitcoin appreciates at 30% ARR over the time period, you end up with an amplification of 2.8. You're getting 2.8 the Bitcoin performance, probably 2.8 the Bitcoin volatility, right? And you can see here, as Bitcoin grows faster, the amplification increases. If we hold the leverage constant, but Bitcoin grows at 50%, you're a 4.7 lever. And you can also see that if you hold the growth rate of Bitcoin constant but increase the leverage, like we're growing Bitcoin at 30% a year, but we go to 50% leverage, now we're 7.8 amplified, a BTC factor of nearly 8. You're getting 8 times the performance of Bitcoin. In the extreme, if you go to 50% leverage and Bitcoin goes on a tear and grows 50% a year, you're getting 22x performance on the equity versus just holding the ETF. Let's take a different slice of this. If I have Bitcoin growing at 30% a year and my credit improves or the interest rates fall, if SOFR falls to 100 basis points and we're able to reduce our dividend rate from 10 to 6, you can see the amplification goes from 2.6 to 3. And you can see that, and then if we consider the next slide, when you actually combine leverage with credit, if you actually get to 50% leverage and you get, and the interest rates fall to 5%, or if your credit spreads compress to 5%, this equity is providing 9.9 times Bitcoin. So the BTC factor goes almost to 10. So what is the universe of assets that would be interested in MSTR? Well, it's the S&P 500, it's NASDAQ, it's the Mag 7 investors, it's Bitcoin investors. And as you can see, MSTR is outperforming all of those competitors right now. And so if what you want is the Amazon of digital capital, then that's strategy. Now, the question in your mind is, can you actually go to 30% leverage or 40 or 50% leverage? So let's look at the credit model. So here we go. This is the existing capital structure, assuming the 40 vol and assuming 0% Bitcoin return.
Saylor says MSTR stock is now amplified Bitcoin, a leveraged way to play Bitcoin's rise. Saylor claims it can offer 2x to 20x Bitcoin's returns through smart, non-debt-based leverage, no interest payments, no maturity risk, just a structured machine riding Bitcoin's momentum. But the market isn't fully convinced, and that leads to the real problem, valuation. Despite massive income and bold innovation, Wall Street still treats MicroStrategy like a risky bet, not the financial juggernaut Saylor believes it is. Now, despite the innovation and record earnings, a valuation gap haunts the stock. With projected $34 billion in operating income and $24 billion in net income this year based on Bitcoin reaching just $150,000, MicroStrategy would sit comfortably in the top 15 companies in the S&P 500. But its market cap rank? Just 96. The PE ratio of 4.7x is shockingly low. The S&P average is nearly 24x. Even among financial peers or crypto players like Tether, the scale isn't respected. Saylor points out that Tether might earn $12 billion in net income this year. In comparison, MicroStrategy has already gained $13.2 billion from Bitcoin, yet Tether gets more credit from investors. It makes no sense, and Saylor is calling it out. He argues that MSTR deserves a premium, not a discount. Why? Because of the intelligent leverage it uses. Because it dominates the Bitcoin options market, with $100 billion in open interest, 5 times that of Bitcoin itself. Because it's inside major indices, pulling in passive flows. Because it taps into far larger markets, $35 trillion in equities, $60 trillion in credit, than spot Bitcoin ETFs could ever dream of. The long-term plan is crystal clear. Phase out all convertible debt. Shift entirely to preferred equity backed by massive collateral. STRF and STRC with 10x plus. STRK with 6x plus, STRD with 3x plus. Then, aim to become the largest treasury company in the world, surpassing even Berkshire Hathaway's $348 billion capital base. But here's the real fear. Everything relies on Bitcoin. If Bitcoin crashes or stalls, this entire structure could collapse. The credit instruments depend on Bitcoin's yield. The stock's value hinges on Bitcoin's rise. The valuation argument disappears the moment Bitcoin wobbles. There's no fallback, no diversification, no safety net. This is a one-way bet. And that's the billion-dollar dilemma. Can a company built entirely on digital gold survive the brutal cycles of crypto markets? Or is this just a high-stakes fantasy waiting to implode? Michael Saylor isn't hedging. He's going all in, rewriting the rules, betting everything on Bitcoin. And for now, the world is watching, nervous, fascinated, and waiting to see whether this bold experiment builds a new Wall Street or ends in flames. Thanks for watching, and don't forget to like and subscribe.